Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Whitestone Reit Annual Report. Whitestone Reit offers a variety of businesses and services through its open-air, retail centers located in growing markets across the country. These convenience-focused centers provide a mix of essential services that cater to the needs of surrounding communities. Some of the key businesses and services offered by Whitestone Reit include food services, restaurants and grocery stores, self-care services, health and fitness facilities, service-oriented businesses, financial institutions, logistics providers, and other convenience-based services, educational resources, potentially including schools or educational centers, entertainment options, such as movie theaters or game centers. By providing a range of essential services, Whitestone Reit aims to establish strong community connections and relationships with its tenants, which are key to the success of its current centers and acquisition strategy. The significant increase in Whitestone Reit's WSR stock price by over 15.6% in the past year can be attributed to a specific event that triggered a substantial surge. On November 4, 2025, MCB Real Estate made an unsolicited acquisition proposal, offering $15.20 per share in cash, which represented a 21% premium to WSR's closing price of $12.56 on the preceding Monday. This offer led to an immediate per-market jump of 11%, indicating that the market reacted strongly to this potential acquisition at a premium. The MCB Real Estate proposal was a pivotal moment for Whitestone Reit, as it not only offered a significant increase in value, but also demonstrated confidence in the company's worth. The stock continued to rise throughout the year, hitting a new 52-week high of $15.75 and experiencing other positive movements due to reported takeover interest from private equity firms like Blackstone and TPG. However, these individual daily movements did not explicitly cross the 15.6% threshold, making the MCB acquisition proposal the primary cause of Whitestone Reit's stock price increase in the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, acquisitions of new properties, increase in occupancy rates, leasing activity, rental income from existing and acquired properties, equity issuances, debt financing, tenant-based diversification, lease terms, and addition of new tenants have all contributed to revenue expansion. Conversely, dispositions of properties, economic downturns in key metropolitan areas, intense competition, increase in property taxes, impairment charges on assets, compliance costs related to laws, decrease in occupancy and rental rates due to competitive environment, inflation, rising interest rates, and market conditions have led to revenue decline. These factors highlight the importance of adaptability and strategic decision-making in navigating the complexities of commercial real estate markets. Net income and profit margins overview. The company's net income experienced fluctuations between 2024 and 2025. Initially, it decreased due to non-cash impairment charges, increased property taxes, and compliance costs. However, the net income increased by $7 million in 2025 compared to 2024, reaching $161 million. Profit margins also underwent changes during this period. They initially decreased due to inflationary price increases, reduced tenant sales, and higher borrowing costs. Additionally, fixed real estate costs did not decrease with the decline in income, further affecting profit margins. However, a subsequent improvement was observed due to increased rental revenues, lower property operation and maintenance expenses, and decreased real estate taxes. The reasons behind these changes are multifaceted. Non-cash impairment charges, increased operating expenses, and delayed development projects contributed to the decrease in net income. Interest rate fluctuations also affected variable interest rate debt, but not fixed interest rate debt. These factors collectively influenced the company's financial performance during this period. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has successfully achieved positive operating cash flow, indicating that it is generating more cash than it is spending on operational activities. This achievement is reflected in the company's financial statements, where it is reported that the company generated $50.8 million in positive operating cash flow. This is a significant milestone for the company, as it demonstrates its ability to manage its finances effectively and generate sufficient cash to fund its operations. The company's success in achieving positive operating cash flow is also evident from the operating cash flow section of its financial statements, which clearly indicates that the company has a positive operating cash flow. This confirms that the company is on a solid footing financially and is well-positioned for future growth and development. The company's debt level and interest expenses have remained relatively stable over the past year. According to financial reports, the debt level has fluctuated slightly between $644.5 million and $649.4 million as of December 31, 2025. However, a significant increase in debt was noted on November 6, 2025, with the issuance of a new term loan worth $17.7 billion. Despite this notable exception, interest expenses have remained steady at approximately $562,000 for the year ended December 31, 2025. There is no indication of a significant change in interest expenses from previous years. Overall, while there are some minor fluctuations in debt levels, neither debt nor interest expenses have undergone any substantial changes. Management is optimistic about the company's outlook, citing several key strategies to drive growth and increase shareholder value. The primary objective is to acquire, own, and operate community-centered properties, which will be achieved through a combination of acquisitions and redevelopment efforts in high-growth markets such as Phoenix, Dallas, San Antonio, and Houston. The company expects rental income to increase year-over-year due to the addition of new properties and rent increases on renewal leases. Management also anticipates minimal impact from inflation due to triple net leases and short-term lease terms. To mitigate risk, the company plans to hedge certain debt transactions through interest rate swaps and maintain property and liability insurance with commercially reasonable deductibles and limits. Management is seeking to diversify market risk by investing in cities with exceptional demographics outside of Texas and Arizona. This strategy will not only drive growth, but also provide a more stable financial foundation for the company. Overall, management's outlook is positive, with a focus on long-term success through employee engagement, equity incentives, and strategic investments in community-centered properties. The company has made several acquisitions and divestitures over the past year. In terms of acquisitions, the company has purchased several properties, including South Hulen and Village Shops at Dana Park. Additionally, the company has exercised its notice of redemption for substantially all of its investment in Pillarstone Capital REIT Operating Partnership LP. The company is also acquiring distressed commercial real estate and has made earnest money deposits on future acquisitions. The company's divestitures include contributing real estate properties to Pillarstone OP and selling properties that do not align with its community-centered property strategy. Specifically, the company sold Kempwood and Sugar Park as part of a reverse like-kind exchange under Section 1031 in 2025, and Providence as part of a like-kind exchange under Section 1031 in 2024. These transactions demonstrate the company's efforts to optimize its portfolio and focus on properties that align with its strategy. The company's financial activities have been documented in various summaries. One notable aspect is its history of paying dividends to shareholders. According to multiple sources, including pages 14, 26, and 37, the company has indeed paid dividends. Furthermore, page 30 provides specific details on one such dividend payment, which totaled $27.8 million. In contrast, there is no information available regarding share buybacks in these summaries. The only mention of this topic is a notation on page 26 stating, "Not applicable," suggesting that the company has not engaged in share repurchases during the relevant period. There are concerns about potential supply chain disruptions that could impact a company's financial performance. According to the extracted summary, these risks are related to economic uncertainty and macroeconomic factors affecting capital markets. Specifically, page 31 highlights the possibility of supply chain disruption due to external factors beyond the company's control. While there is no mention of inventory buildup in the provided text, it is essential for companies to be aware of potential disruptions that could affect their operations and financial performance. By understanding these risks, businesses can take proactive steps to mitigate them and ensure continuity in their supply chains. That concludes the financial summary for Whitestone Reit. Feel free to comment below, and I will be happy to answer them when possible.